You spend your whole life earning a paycheck, and it's pretty easy. Not the work that it takes to make the paycheck, but managing the money because you know what's going to come in every couple of weeks and you can live accordingly. You pay some bills, you do some fun stuff, and then you put away a little bit of money for the future, and that's pretty much it. And then you retire and everything changes. It's the primary reason why I have a job. I help people navigate that change from paycheck to no paycheck. More importantly, most of the time, I actually help them create a paycheck in retirement. That's what we're talking about today. How do you create a retirement paycheck for yourself? Now, I'm going to break down 3 common examples today in the video of how you can create a paycheck for yourself in retirement. I'll give you the pluses and the minuses of each of them because, as they say, different strokes for different folks. Not everything is right for everybody. Before I dive into the nitty-gritty, if you're new here, my name is Antonio Cibella. I'm a financial advisor. I specialize in helping people do exactly what we're going to do in this video, create retirement paychecks that they can count on so that they can get the most out of their retirement and not have to worry about the money stuff. So let's start with a common retirement income strategy. Dividend investing. For today's purpose, I'm going to lump together dividend investing and bond investing because they're sort of cousins. Both rely on taking income generated by the investments. Dividends paid by a company on their stock, or interest paid by a company or a government on their debt. That would be the interest that's earned on bonds. The basic premise of both is this: if you live off of your interest or you live off of your dividends, you won't run out of money because you aren't touching the principal of the actual investment. You're just drawing the income that comes from it, and these provide a regular stream of income similar to that of a paycheck that you were getting while you're working. A key concept with these strategies is that with most investments that pay some sort of income, there are 2 potential ways to make money. First is the income that's paid out, the interest or the dividends, and then second is the appreciation of the investment itself. Think of these 2 like a teeter-totter. When one side goes up, the other side goes lower. Generally speaking here, the higher the income being paid out, which is good because it means a bigger retirement paycheck, the less likely it is that you'll see the other type of growth, the price appreciation. Here's why. A dividend being paid by a stock is a portion of the profits that the company is earning. Rather than reinvest that money back into the business to try to grow the business, they pay out the profits to their owners, in this case their investors, their shareholders. That limits the ability of the company to grow, and the more of those profits that they pay out, the lower the potential growth of the business, and therefore the less likely it is that the share price is going to appreciate going forward. You commonly see this with an investment in a utility company, for example. Very steady cash flow, good payouts, but limited growth. So if you're looking to maximize the size of your retirement income from these types of investments, you can find stocks with very high dividend payout ratios. Just be aware that it comes at the cost of future growth. For bonds, generally speaking, you're going to find higher yields these days from a bond portfolio than the dividend payouts we see coming from dividend-paying stocks, but you've got an even lower upside from a bond than with any sort of stock because you're basically the bank. You're not investing in the company. You've lent money to the company in exchange for an interest rate. You're not an owner. You're a lender. And so you don't participate in any of the profits. That limits your upside potential. So again, the higher the potential income, the more likely you will have less appreciation. Now, this might not sound like a big deal, but over a 30-year retirement, it can make a huge difference because the value of money atrophies away as a result of inflation. If your portfolio value isn't growing at the same pace, you're losing money in a different way, and you're essentially drawing all that growth off of the portfolio. So a steady account value in retirement is actually decreasing in the terms of real dollars, real spending power. Think of it this way. You buy a CD from the bank and you want to live off the interest in retirement. Not completely different than bond investing here. Different risk profile, but the upshot is the interest that you're going to earn. So let's say you find a super long-term CD and it's paying you 5% per year and you put $1 million into it. P.S. Don't do this. This is a bad plan. I'm just giving you an example here to show you that it's a bad plan. And so let's say this thing's like a 20-year term and you're like, I got retirement income fixed. I figured it out. I got $50,000 a year every year for the next 20 years. I'm good to go. Here's the rub. By drawing the interest for income, your $1 million is becoming less valuable each year because it's staying static as inflation is eating it away. On top of that, your income itself isn't growing. And so at 3% annual inflation over 20 years, your money, the $1 million, and the effective purchasing power of your income, that $50,000, have lost more than half of their value. Bad plan. You've essentially guaranteed yourself a consistently declining income and a consistently declining account value in real dollar terms. You found a very, very safe way to lose money slowly. Feels good up front, but a bad plan for the long run. So, the big drawback to dividend or interest investing is that you have to balance the income that you're receiving from them as well as the future growth so you can keep pace with inflation. The second part to it, it's not guaranteed income. I prefer guaranteed income in retirement for people. The paycheck will continue to come. Companies that hit rough spots cut their dividends. It's not abnormal to see that. Sometimes dividend indexes, when you look at them, the change in the payouts changes 20, 30, 40% in bad times. Ask anybody who's ever gotten a 40% pay cut if it's pleasant. It is not. And so if you're living just off of the dividends or a dividend fund or an ETF and you start cashing the checks, it can provide a nice basis for income, but you've got to balance that strategy out with something else because your income can really fluctuate. Same is true for bonds, even more so actually. Cuts in interest rates mean cuts in paychecks, and generally speaking, cuts in interest rates happen at times when the economy's not doing particularly well. That's the worst time to get a pay cut. As for strategy number 2, the 4% rule, I've talked about the 4% rule a ton on the channel. So if you've been around, you probably know my thoughts on it. For those of you who don't know, sit tight. I'm going to tell you, here's the basic scoop. You can invest in a moderate portfolio, draw 4% of your balance in year 1 in retirement, adjust it up each year to cover inflation, and typically not run out of money over a 30-year retirement. I say typically, around 96% of the time, you end up the 30 years later with something more than $0, so you didn't run out. Now, the good part here is the math is sound. The 96% thing is factually correct. It's not made up. Also a positive, it adjusts for inflation. So you're not living in a pay cut vacuum where you're slowly losing purchasing power over the course of your retirement. The drawbacks, and I've said this before here, this is a math equation. This is not an income plan. Income needs change throughout your retirement. It's not a single steady dollar amount throughout the entire 30 years. Generally speaking, you spend more early. You're doing the fun stuff, the bucket list stuff. You spend less in the middle of retirement. And then expenses pick up the end of retirement for things like healthcare costs and long-term care. Retirement spending smile. We've talked about that here too before. So my first issue is that it doesn't give you great flexibility. The second issue is that a lot of times, almost 40% of the time, actually, not only do you not run out of money, but if you follow the plan and you die 30 years later, you end up with more money than you started with. That tells me that you underutilized your assets during your retirement years. You actually could have spent more, enjoyed more, traveled more, given away more. Whatever it is that you wanted to do, more was available to you with a better income plan. I would even say with an income plan, because again, I don't believe the 4% rule is a retirement income plan. It's a math calculation, and it's a good math calculation. The math works. It's a great tool to figure out if you're in the right ballpark. If you've got, say, $1 million and you're like, yeah, I just need to draw 100,000 a year from it in retirement and I'll be good. You're not good. You're not in the right ballpark. That's a 10% distribution. That's a one-way ticket to the poorhouse. So you can use the 4% rule to see if you're barking up the right tree. What kind of income will you need? What sort of retirement balances do you have? Are you going to be able to exist in drawing somewhere in the vicinity of 4%? Good. If so, you're on the right track. But before you actually pull the trigger and start spending money, put an income plan together that takes into account distribution rates, taxation, flexible spending needs, liquidity, etc. All of the things that need to go in beyond just the simple question of, have I saved enough to retire? Strategy number 3, spoiler alert, I saved the one I like best for last. Create guaranteed retirement income that meets your necessary living expenses, and then structure the remainder of your portfolio to provide liquidity for unexpected issues, for the fun stuff, and to meet potential retirement pitfalls that could come down the road, like long-term care. And so you're going to build up enough income to not have to regularly access the portfolio for the day-to-day. Now, as for the guaranteed income part, you can use part of your portfolio to purchase an annuity. I know, before everybody starts hating on the video, I know annuities get a bad rap. Hear me out here. Purchase an annuity that provides a guaranteed retirement income stream for you and your spouse. It's the equivalent of creating your own private pension. Nobody hates on pensions. Now, there are some bad annuities out there. You don't have to get one of the bad annuities, but you can get one that will provide a paycheck for you in retirement and keep things moving just like they were while you were working. And so in that example, you're going to invest a sum of money in exchange for a series of payments, paychecks that you can't outlive. The paycheck will come as long as you are alive. Only do this with a portion of your portfolio, and only if it's needed to meet the day-to-day income needs. Now, some folks may not need an annuity at all. But if you do, because interest rates are higher now, they've gone up from where they were for many years, depending upon the type of annuity. I'm seeing payout rates in the 6 to 7% range, meaning you put a couple $100,000 into something like that, it can generate $1,000, $1,100 a month of guaranteed income that will come in every month as long as you or your spouse are alive, like clockwork. If you've been here before, you've seen me do this plenty of times, but basic retirement income planning is this: what are my expenses? What are my sources of guaranteed income? And what's my pile of money? Buying an annuity is trading some of that pile of money, a small portion, to create additional income to balance out the scales of what you have coming in versus what you have going out. And then you use the rest of the pile of money to cover the other stuff: excess spending needs, legacy planning, protecting from long-term care. All of the other variables, you've still got assets, you still got resources to deal with that. Suffice it to say that whatever route you take, whether you go off of dividends or interest, don't do the 4% rule, but there are modified versions of that. There's something called guardrails. It's not a terrible plan. So if you just want to draw from your portfolio, better ways to do it than the 4% rule. Either way, whatever route you take, make sure that you get yourself an actual plan. If you're in that process, if you're planning, I got some stuff for you. Go on down below. This is me pointing at the description of the video. Check out some of the resources that are down there. There's some good stuff available to you as far as planning your own retirement. Also, a couple of the videos that I talked about earlier in this video, I'll get a little more in depth on both of them if you're interested, right over here.